higher as well by about 2.6 odd percent as well. So that's, the overall picture in terms of how we are starting. On the index, it's a decent start with about 70 points on the Nifty, 18,025. Our market master is Sanjeev Prasad, the Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, great to have you with us here. Thank you very much. You and your team recently published this a big report looking at growth stocks and where valuations are over a number of years, going back the last many years. And the one thing which clearly kind of stood out is that, PEs have expanded, right? I mean, massively over the last 5, 6, 7 years. Let's start there, Sanjeev. I mean, what is the crux of that report that you put out? Are you saying that valuations need to come off quite a bit? Are you saying there is not too much comfort?
Well, two main points over there. One is, if you look at multiples, and if you look at versus history, by itself it may not mean much. But let's say if you look at versus March 19 levels, when the 10-year G-Sec yield and policy rate were at similar levels where they are currently. Look at most of the discretionary names, the multiples are higher compared to where they were trading in March 19. So adjusted for interest rates, discount rate, cost of capital, whichever way we want to look at it, it looks like multiples are on the higher side, which probably means the market is looking at growth accelerating from whatever we have seen in the past. Well, we are not very sure about that for two reasons. Number one is you are seeing a slowdown in discretionary consumption for sure. And number two is you're also starting to see a fair amount of disruption, which is coming across business models for companies which were once thought to be completely, with very, very solid modes, something which could never be breached. But of late, what we are seeing is many of the business models are starting to see some cracks, nothing alarming, but over a period of time, the business modes which people took for granted, I think are going to get breached slowly but steadily. So in that context, I'm not very sure whether, giving those multiples are justified. So our view is over a period of time, you will see, derating in the multiples of many of these high growth / quality stocks.
Okay. By the way, just wanted to point out a couple of stocks. L&T Finance is at a fresh 52-week high this morning. It's up almost about 4.5% right now, post its numbers. Very strong disbursal growth coming through, over 30% disbursal growth. And, the net interest margins as well at an all-time high, as we were telling you earlier, of 7.4%. On the flip side, it is Avenue Supermarts that's under a lot of pressure right now, down almost 5% post its numbers. Sanjeev, good morning. I wanted your thoughts on how to approach the HDFC group now. HDFC Bank has reported very good numbers. The stocks, as we know, have been huge underperformers in the past, even something like an HDFC Life. Do you think the tide is turning here?
So if you look at HDFC Bank, let's start with that one. And HDFC, anyway, will trade in line with HDFC Bank stock price now. So the stock had derated meaningfully. If you look at historically, it's been trading at more like 3.5 times 12-month forward price to book. It's come down to more like 2.8 currently. And if you look at the combined entity that is post-merger with HDFC, let's say March 24 book, which is more or less 1 year forward now, and adjusted for value of all the subsidiaries, the stock would be available at somewhere about 2.4 times March 24 combined book, which is actually fairly attractive, I would say. There's no change in the growth profile of the company, no change so far in the ROE profile of the company. Yes, that will differ just a bit going forward post the merger. But anyway, the mortgage business is a much more, I would say, lower risk, lower return business. So in that sense, it doesn't really matter that much that ROE is coming down. So yeah, HDFC Bank was quite okay at current levels. One of our topics, I would say, in the overall market. HDFC Life, after period rating, it has started to see some upward mode. Valuations are okay, I would say, compared to, let's say, an ICICI Pro Life or an SBI Life. It is still on the higher side, it's about 3 times EV as of now. But, in this current environment, I think it's a reasonably good stock to own. It's a long-term good growth story, but compounding for a very, very long period of time. So in that context, 3 times the middle value may not be a very bad value for in the context of the broader environment.
Hi, Sanjeev. Good morning. Good to hear your thoughts. Sanjeev, since we're talking about banks in the financial space, what about the PSU banking theme? That was the start of 2022. For those who hold, what's your take? And do you believe a fresh entry as well could be made at these levels, or bulk of that re-rating has already taken place?
I would recommend a slightly longer term horizon over here. In the sense, the stocks can be fairly volatile. If there's any bad macro event, etc., the stocks can correct quite meaningfully. If the macro environment is decent, you could still see some re-rating in most of the PSU names. So if you look at something like Canada Bank, Union Bank, etc., most of them are still trading below book, about 0.8 times 1 year forward price to book. Next 2 years, we don't see too many issues with credit quality. Credit growth should be fine. So in that context, the stocks are okay to hold, but do keep a slightly longer term horizon in mind, just to tide over any volatility that you may see in the short term, more linked global or domestic macro factors, nothing to do with the fundamentals of the banking sector, which is currently very, very solid.
Sanjeev, just to go back to what you began by saying, we're seeing some cracks in what were earlier thought to be disruption-free, some disruption in business models. Could you just talk about one or two just as examples?
Sure. I mean, look at let's say the automobile sector. We're seeing a lot of disruption in terms of competition from electric vehicles, which will surely, but slowly but surely it will come in. If you look at the four-wheeler segment, I can talk about Maruti as an example. If you look at how Maruti's competitive positioning has changed over the last 6-7 years, it's gone from being a very dominant player in the dominant segment, let's say 8-9 years back, when hatchback segment used to be something like 53% of the total volumes of the passenger vehicle mix. That's FY 2014. Fast forward to current, if you look at Maruti's position, it's unfortunately become a fairly average player in the dominant segment now, which is the SUV segment. So on the one side, hatchback segment has gone from 23% mix share in FY 14 to something like 38% now, or in FY 22. On the other hand, SUV segment has grown from 13% of total passenger vehicle sales to something like 40% in FY 2022. So I don't know why the market still insists on giving such high multiples for a business model which is considerably weakened, in the sense, it has a much lower market share in the dominant segment now compared to very high market share in the dominant segment, which was valid 8-9 years back. So structurally, the company's market position has weakened significantly, but the multiples which the market wants to give is still on the higher side compared to wherever the stock is traded historically. So I guess the market is betting on the fact that you will see a quick turnaround in the fortunes of the SUV business of Maruti. That remains to be seen. They have a fairly decent a bunch of products in the pipeline. If they manage to regain some market share in the SUV segment, well and good. But if they don't, I suspect the stock could see further derating. Do keep in mind the fact that the SUV segment is a very, very competitive segment now. So to come and take a big market share here, it's going to be it's going to be an upper class as far as Maruti is concerned.
Okay, that's very interesting and very well explained. Anything else? One more example, Sanjeev, from any other space?
Yeah, so many. We can look at Asian Paints, an example. Again, a superbly run company, fantastic business model. I don't see much of disruption here coming from change, in the, let's say, the strengths which matter really for the paint business, which is brand and distribution. I don't think distribution model will ever change as far as the paint industry is concerned. So that way, the paint industry will probably be one of the last sectors to be disrupted. Having said that, you are seeing a lot more competition coming, and this is from the likes of, and I would suspect fairly formidable players like Grasim or JSW, both of which whom have fairly ambitious plans in the industry. So far, what the market has taken a call is that the tier 2, tier 3, the number 2 and number 3 players will get affected a lot more. That is Berger, Kansai. And they have seen a big derating in the multiples. But somewhere the belief is that Asian Paints, because of its, absolutely amazing execution in the past several decades, will still manage, to retain its top position and also its market share. That needs to be seen. We will see how the paint industry evolves going forward.
Okay. All right, Sanjeev, we will leave it at that. Thanks a lot for joining in, and it was a pleasure speaking with you. Have a great 2023. We'll, of course, chat with you soon. The market has come